Hey everyone, welcome back to Corporate Decoder. Today WeShop Holdings Limited just filed its 6-month financial update, and I am seeing a major shift in how they are presenting their story. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company has released its interim financial statements, and it looks like they are really trying to reshape perceptions after a rough period. We are looking at WeShop Holdings Limited, a company in the communication services sector, specifically internet content and information. They have a market cap of around $55 million, with the current price hovering around $4.69. This is a stark contrast to their 52-week high of $250, which tells us they have experienced significant volatility. They are a very small company with only 20 employees. This filing is a Form 6K, which is essentially a report of foreign private issuers. It is submitted monthly, and this particular one covers the period up to August 2026. The key pieces of information within this filing are the unaudited, condensed, consolidated interim financial statements for the 6 months ended the 30th of June 2026. And the company's operating and financial review for that same period. It is important to note that they are filing as a Form 20 filer, meaning they are reporting their annual financial statements under US securities laws. Now, let us dive into what the company is telling us about its performance. WeShop is presenting its operating and financial review. This section is crucial because it is where management explains the numbers and provides context. They are framing their results for the first half of 2026, considering the massive drop in their stock price from $250 to under $5. This review is likely an attempt to explain what happened and what their path forward looks like. We have seen some insider activity recently with an executive exercising options and adding shares, which sometimes signals confidence, but given the stock's history, it is hard to say for sure without more information. The heart of this report, of course, are the unaudited, condensed, consolidated interim financial statements. These are the actual numbers that show how the company performed financially. While I cannot read the entire financial statement here, it is important to look for key metrics. We want to see revenue trends, profitability, and cash flow. Given their market cap and stock performance, it is likely that revenue has been volatile or perhaps declining, and profitability may have been a significant challenge. We will need to see if they are showing any signs of stabilization or growth. If we were to look at the broader picture, WeShop operates in a very competitive space. Companies in the internet content and information sector are constantly battling for user attention and advertising revenue. With only 20 employees and a $55 million market cap, they are a very small player. Top institutional holders like BlackRock and Vanguard have small positions, suggesting that while some large funds are involved, their stakes are not substantial. Historically, companies that have experienced such a drastic drop in stock price from $250 down to around $4.69 often face significant underlying business challenges. Think about companies like Radio Shack, which went through multiple reverse splits and struggled to adapt, eventually leading to bankruptcy. While WeShop is not there yet, such a massive price decline often signals issues with revenue, profitability, or market position. A 70 to 90% decline in stock price from its peak is a serious red flag, and often it takes years to recover, if at all. One of the biggest things to watch for in these interim statements is whether they are showing any signs of turning the corner. Are revenues growing? Are they becoming more profitable, or are they still in a period of contraction? The fact that they are filing this report and providing an operating and financial review suggests they are actively trying to communicate their situation to investors. What is really interesting here is the contrast between the company's past valuation and its current state. A jump from $4.33 to $250 in its 52-week range is wild. It suggests either extreme speculative activity or perhaps a significant positive event in the past that has since soured. Looking at the operating and financial review, we need to see if they are addressing the core reasons for this decline. Are they talking about new strategies, market shifts, or operational inefficiencies? The absence of specific numbers here in this overview makes it hard to judge, but the financial statements themselves will paint a clearer picture. We would be looking for revenue growth, gross profit margins, and net income. Any significant improvement in these areas would be a positive sign, but given the context, we must be cautious. The market cap of $55 million for a company that once traded at levels implying a much higher valuation indicates that investors have significantly re-evaluated its prospects. The 20 employees suggest a lean operation, which can be good for cost control, but might also limit their ability to scale or innovate rapidly. What I'm actually looking for is clear evidence of a sustainable business model and a path to profitability. The extreme volatility in their stock price and the vast difference between their 52-week high and current price are major concerns. Without seeing the actual financial statements, it is hard to give a definitive verdict. But this filing is an attempt by the company to communicate its current status and future outlook after a period of significant stock price decline. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this helpful, like and subscribe and join our Discord in the description.